Good afternoon. It's Tuesday, August 6th, 2024, just after noon on the East Coast. This is Robert Sin at CEO Technician on X, at Goldfinger on CEO.ca, and you're watching Goldfinger Capital on YouTube. As always, if you enjoy these videos, if you get value from this one in particular, please hit the like button and make sure you subscribe to my channel. Also, feel free to comment. Let me know what you think about this video, and also share it. Share it on your social media, share it with your friends. We're going to be talking gold today. This is all about gold, not doing stocks, not doing junior miners, not doing even gold miners. We're just talking about gold, the yellow metal. If you look back on my video history, you'll find October 2022, I made a video about gold. It was called like the Uber gold, the Uber gold bull thesis, or something like that. Um, and it got a lot of views, right? I had a smaller number of subscribers back in October 2022. And also, if you look back in the gold chart, October 2022, gold was trading about 1625. It was made during this time. Gold had had a really bad year in 2022. Remember, the Fed was hiking interest rates really aggressively. Dollar was pretty strong. Gold was really out of favor. So I made that video, talked about a lot of things, a lot of bullet points in that video. And what I found interesting looking back on that that video is a lot of the bullet points haven't played out. But gold was 1625 then, and it's 2427 right now. So we're up about 50% since that video. And what's most interesting is the last bullet point that I talked about during that video was Fed easing, the prospect of Fed easing, and the end of quantitative tightening, and the resumption of quantitative easing through yield curve control. And that was 22 months ago. And here we are today, and it still hasn't happened. The Fed still hasn't cut yet. They're holding off to the last possible moment. Back in October 2022, I was speculating the Fed could cut in the first half of 2023. Well, that was way off, right? And this is a great lesson. Like, a lot of our analysis narratives we create, potential, potential scenarios that we come up with, they don't play out in the market, right? They don't play out. They're just a thesis, a theory, and they're often wrong. And really, price is king, and we need to focus on price above all else. Well, gold put in that bottom. Remember, it was like the triple bottom in Q4 2022. Gold put in that triple bottom and began to rise at the end of the year. Well, that was very positive price action in the face of what most people view to be negative fundamentals for gold, a negative macro backdrop for gold. So that was a wonderful example of price diverging from the broader narrative and from investor sentiment and giving us a bullish divergence. Well, that was a very positive signal, and you can see that gold has been in an uptrend. It's carved out an uptrend ever since. So here we are today. Let's talk about where we are today. And you see the title is Turbo Nirvana. Well, okay, that's maybe a little sensational, but I'm going to talk about the potential for how things could play out here. Let's start with what we know. Let's start with what we know right now, and let's build up from there. So the first thing that we know for sure is based upon the last non-farm payrolls report in the U.S. that we received on Friday morning. The unemployment rate is up to 4.3%. That's off of a low of about 3.6%. So we're up significantly, and the Sahm rule has been triggered. So whenever the unemployment rate spikes, jumps by more than, 0.5% off of a major bottom like it carved out in 2023 and early 2024, well, that triggers a recession indicator called the Sahm Rule. It's really not more complicated than that. And based upon a sample size of, I think, 8, it's 100%. It's a 100% indicator. Now, that doesn't mean it's going to always work. Sample size of 8, even a sample size of 10, frankly, it's not big enough to say this is a 100% indicator. But let's say it's definitely increasing the probability of a recession substantially. Now, also, the yield curve has uninverted. Well, at least it did briefly on Monday, but the uninversion basically means that the 2-year yield has finally fallen below the 10-year yield. Okay, so we've been basically with the 2-year yield above the 10-year yield for much of 2022 and 2023 and the first half of 2024, right? The 2-year note has been up near 5% just as, recently as May, okay? And the 10-year was 4.5%, 4.6%. So the 10-year yield was under the 2-year yield, which is basically a sign that the Fed is tight. The Fed is holding short-term interest rates at a high level to press down on the economy and press down on inflation. Well, when it uninverts, that's a signal, tried and true throughout history, that the economy is slowing down and the Fed is about to pivot. The Fed is going to start easing. And when the Fed starts a protracted easing cycle after holding monetary policy relatively tight for a period of time, like it did in 2005 and 2006 to push down on that overheated housing market, well, a recession is around the corner, like it was in 2007, 2008, and 2009, right? The recession in the US definitely started at some point during 2007, although economists can argue about the exact starting point. 2008 was a very bad economic year everywhere. I think everybody can agree on that. And the recession continued into 2009, right? So the recession, just those two pieces of information, we can analyze all the data and make arguments every which way, but just those two pieces of data, the yield curve on inversion and the Sahm rule, put them together, we have very strong probability that a recession is starting now or it's about to start very soon. So let's just make that assertion that a recession is now likely based upon those two very strong indicators. Then I'm going to add a little more evidence to it. So the manufacturing data, okay, the manufacturing data is soft. It's been soft for many months. And frankly, a lot of it is pointing to a recession in the US manufacturing economy. Well, it's not 100% a correlation that employment's going to follow it, but it's pretty damn strong. You can see this chart. And it seems to me like the darker blue line is a leading indicator for the lighter blue line. So if that holds true, then we're going to see non-farm payrolls tick under 100,000 and potentially even flip negative like it has in the past. Like look back here at this chart. Very often when the ISM manufacturing PMI gets down to these levels, well, payrolls are going to go negative. All right, again, doesn't have to happen. It's not 100%, it's not a guarantee, but it's a pretty strong correlation. Bankruptcy filings. Okay, you can see back in 2009, they were at a very high level because that was at the height of the global financial crisis. And they spent the next 5 years declining as the economy strengthened. Well, what's been happening since early 2022? Well, they were at a very low level because of all the fiscal and monetary stimulus that was poured into the economy during 2020 and 2021 to fight the pandemic. And they've been uptrending pretty strongly for the last 2 years. Well, that's a that's a pretty strong precursor to a recession if I've ever seen one, right? So the evidence is adding up. It's mounting, right? Weekly jobless claims bottomed in early April. And for the last 4 months, they've been trending higher. So they got down to about 210,000 jobless claims at the bottom there, the lowest point there in early April. And we printed 200, almost 250,000 last week. So that's a significant increase in weekly jobless claims. Another feather in the cap of a weakening economy. I mean, the evidence is really mounting here, guys. Construction, residential construction employment. So there's a lot of um, signs. Just look around me in South Florida. Buildings are being completed right now. A bunch of buildings in downtown Fort Lauderdale are being finished. Once those jobs are finished, there's a huge amount of housing supply on the market in Fort Lauderdale, and there's not enough buyers to soak it all up. Well, what's going to happen to all those construction workers who have been working hard for the last 2 years building all this new supply? Well, they're going to be laid off, or they're going to have to find new job opportunities, right? There's just not a bunch of new projects that are going to get built after these get done in 2024. And I think that's a consistent theme throughout most of the country. And you can see the darker blue line, total housing units under construction. Look at that. That's super negative. That's lower than it was at the low in 2020. Now it's not as bad as 2008, but hey, it's on the way there. And look at these recessions. The early 90s, that was a pretty big housing downturn in the US. Okay. In 2007, 2008, 2009 was a huge housing downturn in the US. Well, this is looking consistent with how those two looked as they were getting started. Um, I don't know. That's not a great sign. So putting all this evidence together, and I kind of went through this in this post on my Substack. This is a premium post. I unpack the recession indicator, the case for the recession, and talk about how to position your portfolio for a recession. And I'm probably going to do a part 2 on that over the next week or so because I think it's such an important topic. So subscribe to my Substack at Goldfinger Capital. That's $8 a month. Small investment, you get a lot of value out of that. There's also a lot of free content. So if you don't feel like paying the $8, just go ahead and sign up and get my free stuff. But the the case for a recession is very strong. I'm not a PhD economist in an ivory tower at the Federal Reserve, but I've been at this game long enough and I've seen enough of these that I think I have a pretty good feel for it. And this data is making a very strong case that a recession is imminent. Again, that doesn't mean it's 100%. The economy is very tricky. Macroeconomics are extremely tricky and things can change, but I would say we're around the 80 to 85% probability marker at this point in time. So let's just assert a recession is happening here at the end of 2024. So how do we play it? Well, we know from history that the US dollar is one of the first things to get sacrificed during a recession. We just use history as a guide. Um, when the economy starts to contract, right, and more people are out of jobs, maybe their incomes are actually falling or stagnating, but their bills keep piling up. Remember, when you're in debt, you owe interest. So if your income stagnates, your overall quality of life gradually gets worse over time because you have to continue to pay the interest on the debt, and that continues to accrue and accumulate and get bigger and bigger, right? So the U.S. is a debtor nation. The government has a huge national debt, right? The average household is in debt. credit card debt, mortgage debt, um, all kinds of debt, right? So when the economy stagnates or, God forbid, contracts, it's a huge strain on everything. And the Federal Reserve and the government snap into action because they realize that it can get dire very quickly. Just look at the extraordinary amount of stimulus and policy actions that were brought forth in 2008 and 2009 to counter that financial crisis, and then look at the even more extraordinary levels of policy actions in 2020 and 2021 to counter the pandemic, right? We are talking about oceans of, liquidity being thrown on the economy and financial markets and in handouts to the average, citizen. Recall those COVID programs. What the hell, the CARES Act or something, where they were literally giving away hundreds of thousands of dollars to people that were making fraudulent filings saying that they needed assistance, but they didn't actually even, they just started the company yesterday, right? So, long story short, the dollar gets sacrificed. Whenever money has to be printed, whenever handouts are given to sort of, to quote unquote, stimulate things, the dollar gets sacrificed. The dollar falls, right? The dollar got clobbered in 2007 because the Fed started easing. The Fed gave the signal that there were problems, and there were clearly problems as banks started to fail, and the housing market clearly went into a downturn while the dollar got clobbered in 2007. 2008 was a messy year for the dollar because there were so many cross currents and there were so many margin calls that it created some shorter term dollar rallies throughout the year, but that was actually really bad for markets. But then they got clobbered again in 2009. Once they got containment on the crisis and just kept the liquidity fire hoses firing at the economy and markets, the dollar got clobbered again in 2009, and we saw the same in 2020. And we could go back in time and it's the same story, but every crisis now, the policy responses get bigger and bigger and bigger because the economy is bigger and the debt is bigger, right? So looking at the dollar, this is my technician hat here. Dollar had a tremendous rally during 2021 and 2022 as the Fed tightened, raised interest rates, raised the price of money, tightened financial conditions. The dollar appreciated. That was completely logical. The dollar got hammered at the end of 2022 and into 2023. And it's been sort of creating this bear pennant for the last year. So just simple TA, the weekly chart is showing a bear pennant. Well, it's on the cusp of potentially breaking down. If it breaks down through that 102 level on the US dollar index, I would project a fall probably to at least 98, maybe even as low as 96. There's definitely a lot of downside potential here. And if you think bigger picture cycles, well, if this is a new confirmed bear market cycle, well, it's going to fall. It's eventually over time going to fall a lot further than 96 on the US dollar index. It's probably going to retest those 2021 lows around 90. But just simple, 102 is a big level here, and this bear pennant. I mean, that's my interpretation. This has been a bearish consolidation here at the end of 2023 and early 2024 is about to resolve lower. And when you overlay the technicals with the fundamentals that a recession, that we're on the brink of, a recession, and the Fed is going to have to really ease a lot here at the end of the year and into 2025, well, it all lines up, right? So what happens to gold when the dollar is falling and the economy moves into recession? Well, we have a few examples in the last 20, 30 years, and the answer is pretty simple. Gold rises ahead of the recession. Once the recession begins, there can be a period, like once it's confirmed and panic sets in, things can be very messy. Like, take an example, March 2020 or September, October 2008, right? Gold had some crazy violent moves, down, up, down, up. And I kind of feel like, so I have a few different time frames I want to look at, but I kind of feel that's what gold is doing. So just the 4-hour chart, look at gold the last few weeks. I kind of feel like that's what's starting to happen here. The recession signal is getting stronger. We're getting close to the point of confirmation, and gold is trading in violent ranges, right? This is consistent with what we've seen in the past. But once the recession is clear, the policy responses start to pour in, the trend should resume, and gold should resume its uptrend, just like it did in 2009, okay, just like it did in 2020. Remember, April, May, June 2020, gold rallied through August, right? So from the bottom in March, it was a very strong 5 months for gold. In 2009, gold had a fantastic year. Gold had another fantastic year. Let's actually pull this up. Let's pull up the quarterly chart. So here's the 2008. Here's those crazy months at the end of 2008. Well, these are quarters actually. You see the volatility there at the end of 2008. But then look at that uptrend, right? It went all the way through to August 2011, right? That was a tremendous move as the Fed was doing quantitative easing. They had interest rates at zero. All these policy responses kicked in. The dollar fell, gold rose, right? And then here's 2020, right? And it peaked late in 2020 as the market started to figure out, inflation's going to become a problem. In 2021, it began to really rear its head, and the market started to get ahead of the fact the Fed is going to have to tighten this and rein this back in, and gold went into that. I would call it a consolidation. So some people might call it a cyclical bear in 2021 and 2022, but I would say it's a bigger picture consolidation. You can see it never broke these longer term key moving averages. It just found support there and then proceeded higher. Okay. So I feel like that's where we are, right? And so that's also why, if I zoom farther down in these bullet points, I talk about seasonality. August is usually a good month for gold. I'm not so sure that it's going to be this year. I just feel like we're in a messy period, and there could be a lot of volatility here, August and September. Doesn't mean I'm bearish on gold. I just think that we're going to have a messy time here. And if you're an investor or trader, you want to focus on buying low. So buy on the big down days, like, we had, yesterday where gold fell almost all the way to 2,400. Buy on those $100 down days. Don't buy on the $100 up days or the $50 up days. Another tip, which anybody watching this video is probably a pretty seasoned veteran, when it comes to gold, but don't chase breakouts in precious metals. Don't chase breakouts. Gold gets above 2,450 or 2,500. You don't buy the breakout. You buy on the down days, and if you're a trader, you sell the breakouts, right? That's why there's all these failed breakouts that happen, failed breakouts and breakdowns, right? That's how precious metals and markets in general tend to trade in 2024. All these traps, shorter term traps. If you're a long term investor, you want to buy when you're not seeing gold in the headlines and the price has been down a few days in a row, right? What we know. Okay. Yeah, enough about trading and tactics. Back to the macro fundamentals, right? So the dollar gets clobbered during recessions. We know that from history. This time is not going to be any different. The 2001 recession was pretty short lived. I don't know, it was like 8 months, 9 months. Wasn't that deep. It was pretty mild. But gold bottomed in 2001. So it was from a very low level, whatever it was, 260 an ounce. And maybe it ended the year at 300 or 295, but that's still a 10 or 15% move, right? So gold was up in 2001 off of a very low bear market washout level, but it was up. Gold was up in 2008. Gold was up in 2009. Gold was up in 2020. So recession years are bullish for gold, and we have a long track record. We could go back to the 70s and see that track record works pretty damn well. So gold now, remember, gold has faced headwinds in 2021, in 2022, in 2023. Gold faced headwinds due to central bank tightening, tighter financial conditions, and a higher price of money. Well, now in 2024, that has shifted. The headwinds have turned into tailwinds in 2024. And we're going to see 56 rate cuts around the globe in the second half of this year. So starting a month ago until year end, until New Year's, 56 rate cuts. That's the forecast. Could be a few more, could be a few less, but it's going to be a lot of rate cuts, a lot of easing, a lot of money becoming worth less a little bit faster during the second half of 2024. Remember, all fiat currency is a race to the bottom, right? It's a global race to the bottom, zero purchasing power. People losing 99% of the value of their money over a 40 or 50-year time frame, right? So holding cash and keeping money on your checking account, well, yeah, you need it to pay bills, but if you put any more than just what you need for expenses in there, you're sure to lose purchasing power over time, right? And gold is that timeless store of value, way to counter that devaluation, that depreciation of paper currency over time, right? Gold holds its purchasing power over decades, over centuries. So the Fed is much too tight here. And this is something I've talked about a lot in recent videos in the last couple of months. 5.5% on the Fed funds when inflation is 2.5% is way too tight. And now with clear signs and cracks forming throughout the economy, the Fed is going to have to move pretty quickly. That doesn't mean they have to do an emergency rate cut. I think the only way we would see an emergency rate cut is if we saw major, liquidity strains in bond markets, corporate debt markets, which we're not seeing yet. And it would be, financial markets wouldn't be down 200 points in the S&P, they'd be down 500 points. And then you might get an emergency rate cut. But an emergency rate cut is an admission of failure to some extent by the Fed, and it's a sign of panic. So they're going to hold off on that until they have no choice, right? But that doesn't mean they can't signal 50 basis points in September. They can't. It doesn't mean that they won't signal that we need to get Fed funds down to 4% by a certain time frame. That doesn't mean they'll commit to it, but they can hint at it quite strongly through their various Fed speeches, their speakers. And certainly Powell at Jackson Hole in a few weeks could send a very strong signal that markets would pay full attention to, right? So the Fed is too tight, and I expect them to cut at every meeting through year end, and at every meeting in Q1 2025, and at every meeting in Q2 2025. The magnitude of those cuts are going to all depend upon the data, but they're 150 to 200 basis points too tight, so they're going to have to cut pretty aggressively here. I also expect as they start cutting interest rates, they will end the balance sheet, reduction that's been going on. And quite likely they're going to sort of do a stealth QE. So instead of allowing the bonds that are expiring in the Fed's portfolio to mature fully, they're going to reinvest those proceeds. So they're going to do a little bit of a stealth QE where they reinvest the proceeds from the Fed's balance sheet into the long end of the curve. So they're going to be buying long dated treasuries in a bit of a stealth yield curve control. Watch it. And we're probably going to see the yield curve steepen a lot as the Fed cuts. The 10-year might stay at 4%. It might even go up to 4.2% or something. But the 2-year will begin to price in all this Fed cutting. It'll probably drop to 3.5 or maybe even lower over the next 6 months or so, right? And so the Fed will want to rein in the long end of the curve because the 10-year note is the most important rate of interest in the world. It sets the price for a lot of things, including mortgages. So watch. They're going to start doing a yield curve control, which could also just be called QE, right? And then once they get the stealth working, then they might do the not so stealth as needed, right? And why are they going to do this? Well, we could spend hours on this, but basically, let me see if I can expand this a little bit. Yeah. So Fed interest rate expense is rising, and it's going to rise even further. And this is happening at a time when, we just had 3.6% unemployment, 6 months ago. So we got full employment, supposedly strong economy, and the deficits have never been bigger. The debt has never been greater, and the interest expense on the debt is rising at an alarming rate. And you can see it's only going to grow much larger over the next decade. So this is a major problem for the federal government. Major problem. These graphs are a little tricky, but the most important thing to understand is that we've never had these kinds of deficits when we've been at full employment with a strong economy, right? So what happens when unemployment rate jumps 100 basis points or 200 basis points? It gets up to 6%, 6.5%. What's going to happen to the deficit then? Well, anytime we have a recession, the deficit swells. Well, it's already swelled, and we supposedly have a strong economy. So the main takeaway from these charts is the situation could become way worse than it is today. People are already worried about it today. Well, imagine if the economy really weakens. The Fed is going to have to support the Treasury, and that is the turbo nirvana for gold, right? That is, we have not entered that yet. And these things tend to take a little longer than we always think. But we could be looking at it here in the next few years. So the Fed is too tight. They're going to ease. QE is coming next year. It's going to be a stealth version of QE, but it will be very bullish for gold. De-dollarization, central bank diversification of reserves. All of this is continuing. China stopped buying gold for 2 months. All games. All games. They're still buying it stealth. Okay, they're still accumulating it. So is India. So is Turkey. So is Russia. Um, and here's the most important thing. China's economy is weak right now, and they're worried about inflation being too low. So they want to stimulate. China should ramp up its fiscal stimulus to spur economic growth and set a firm inflation target to prevent the country falling into a low inflation trap. Quote unquote, turning Japanese. China's not going to allow that to happen. China's not going to allow that to happen. So they are going to stimulate. And this is a quote from literally the guy at the People's Bank of China. We need to increase the intensity of macroeconomic policies, especially to implement the already arranged fiscal expenditures as soon as possible. So they're gonna fire hose, liquidity into their economy and into markets. Probably not bearish for gold, guys. Okay, so I mean, the fundamental case is pretty compelling for gold, right? And then, we look at the chart and somebody says, well, it's gone up so much. It's gone up so much. When you look at this on an inflation adjusted basis, when you look at this in comparison to global debt, the, US unfunded liabilities, when you think about it in terms of budget deficits, this is just scratching the surface of what's possible. Okay. That being said, I don't like war headlines moving gold. I always hate this. I hate it. Well, it's not good for the world, but also it always seems to screw around with the gold price. We have these false starts essentially. So when the war is starting, when the missiles are in the air, gold has a big spike in the futures, but that always gets reversed, right? It always comes back down. It never holds, and it just creates a bit of I would say, a false price, signal in the near term. Bigger picture, longer term, that all gets smoothed out, and the trend resumes. But in the near term, I don't like what's going on in the Middle East, and that also sort of complicates my near term outlook. That's why I think August could be messy, and don't focus on the seasonality. Gold does not have to go up here in August. But bigger picture, this is a powerful breakout, and don't overthink it. Don't overthink it. This is a bull market. So until we get overwhelming evidence to the contrary, you stick with the trend. This is a bull market trend in gold, strongly supported by macro fundamentals, secular trends that aren't going anywhere anytime soon, right? So that's why we don't overthink it. And then finally, from a sentiment standpoint, I remember August 2011. I remember August 2020, right? Those were two pretty important tops in the gold price, right? Like, I remember the headlines. I remember talking to other investors. This is nothing like that. Sentiment is way more calm. I don't even, I would say, yes, most professional investors have a positive view of gold here, but that doesn't mean that's what bull markets are made of. You need to have bullish sentiment for price to go up, but we're nowhere near a euphoric blow off top. That's my point. That's my point. Um, and then final point, like, what can turn bearish for gold? Well, okay, so the bearish things we want to look out for, if somehow this de-dollarization theme, like, let's say Russia and Ukraine kiss and make up, Putin, maybe Trump gets president and becomes president again, and Trump and Putin kiss on TV, and it's all good between the U.S. and Russia, and Trump goes to Beijing and kisses Xi, and all the world trade is, everything is great again, everybody's friends again. Well, that would be a gold negative. Okay, what's the probability of that happening? I'd say pretty low. Um, the Fed, for some reason, the recession doesn't happen. The U.S. exceptionalism continues. The Fed doesn't have to cut that much. Um, and then all the politicians in Washington all agree that they're going to spend less, and we're not going to have these big deficits anymore. They're all going to take a pay cut. Well, that would be negative for gold too, right? So just ask yourself, what are the probability of those things happening? And then look at the reality of the world with sober eyes, and then go buy some more gold. Gold stands as truth in a world filled with misinformation, lies, and propaganda. Gold is truth. Simple, powerful, timeless store of value with no counterparty risk. Thanks for watching, guys. Hope you got some value out of this. Tell me what you think in the comments section. And again, don't forget to subscribe and hit that like button. Until next time, have a powerful week.